Okay, we are recording. Hi, everybody. I am here in my office here at William Woods still. Um, and I'm doing this recorded lecture for Chapter 3. I know most of you at this point have taken the first exam, although some of you still are set to take it on Friday. So that's okay. I wanted to go ahead and get this recorded lecture for Chapter 3 done so that if anybody was wanting to look ahead at chapter 3 and go through the PowerPoints or listen to the lecture, that it would be available to you. So there's not a whole lot of new information in chapter 3 because what we're basically doing in chapter 3, and I mentioned this a few times in class, is that we're taking the transactions, right, that we analyze, the transactions, and we're doing the actual journal entries instead of just posting them to the T account. So a lot of it's going to look familiar. The new part, again, is going to be the journal entries, which we're going to get a lot of practice in class with. So anyway, I'm going to share my screen with you and we'll go through these PowerPoints together. So this again is chapter 3, and I just did the start slide. Okay, good. So you guys should hopefully be able to see the chapter 3 PowerPoints now. So chapter 3, you see the title is the General Journal and the General Ledger. So the journal entries, and we've mentioned these in class before, the journal entries are how we record transactions. A collection of all of the journal entries is our general journal, right? General journal is kind of like the diary of the business, right? We record all of our transactions in there. And then we post those transactions to the T accounts, AKA the ledger accounts. And the general ledger is a collection of all of the accounts. So again, we don't have a lot of new information. It's mainly this chapter now we're focusing on actually recording the transactions via journal entry. Okay. So the general journal, again, the general journal, sometimes you could say, and I know that the book refers to it as kind of the diary of the business. It's known as the book of original entry. It shows the debits and the credits, the entire transaction, how we record that transaction. Similar to the T accounts, the general journal would have a column for debits, a column for credits. We get the information to record from our source documents. So things like canceled checks or carbon copy of checks or bank statements or labor time tickets or vendor or supplier invoices, right? We take those source documents. That's how we know what needs to be recorded, what amount it needs to be recorded for, what date it needs to be recorded on, all that good stuff. And so we would do our journal entry into the general journal first, and then it gets posted to the ledger accounts or to the T accounts that we got practice with in chapter 2. So here's our first transaction that we're going to look at. Again, this is a transaction that we looked at in chapter 1 when we looked at, okay, how would this transaction impact the accounting equation? And then we looked at this in chapter 2, okay, how would this transaction be recorded in the T accounts? And so now we're going to look at the journal entry, right? We're going to add the journal entry to that. So this one says, on June 1, Jay Connor deposited $90,000 in a bank account in the name of Connor's Whitewater Adventures. So here's our deposit receipt. That would be the source document for this transaction. And so again, just like we got practice with in chapter 1 and chapter 2, the owner's investing money into the account. So we've got cash going up. We debit cash, 90,000, and then owner capital going up 90,000. So we credit owner capital. Hopefully we remember that assets increase with the debit, decrease with the credit. Liabilities, capital, revenue increases with a credit, decreases with a debit. here's what that journal entry would look like. So we would debit cash, the account that's being debited, or the accounts plural, because sometimes it could be more than one. The accounts being debited are listed first. So we list our debit accounts first, the amount to be debited, and then we list our credit accounts next and the amounts to be credited. So, you know, you'll see the date here, the page number of the general journal, on part 5 or number 5 down here, indent further information to record the original investment by Jay Conner. You know, a lot of this, especially when you're looking at, you know, thinking about like the day and the, you know, the page number and things like that, you know, some of that is, you know, automatically in place through the accounting software that we would be using. So again, if we were to record this transaction, debit to cash, credit to owner's capital, right? And then once we do this journal entry, then we post it to the T account. And so we remember our T accounts, hopefully. We're going to get more practice with them in chapter 3. So here's our next example. June 2nd, Conner's Whitewater Adventures bought equipment, paying $38,000 cash. These are both assets, cash and equipment. Again, assets increase with a debit, decrease with a credit. So in this case, we've got the equipment asset going up. We're debiting equipment. We're crediting cash. So again, the journal entry would be a debit to equipment and a credit to cash. And it shows you that journal entry here. Debit equipment, credit cash, bought equipment for cash. So not too bad. It's really, you know, we've been getting practice with it already, but now we're going to extend that and we're going to do the journal entries. So we've already gotten practice with how would this impact the accounting equation. We've already got practice with, okay, how would this be recorded in the T accounts? Now we're doing the actual journal entry here in chapter 3. Okay, so here's another example. Conner's Whitewater Adventures bought equipment on account from Signal Products, $4,320. Remember that on account means we did not pay cash. We created a debt that we'll have to pay back. So that's accounts payable, right? That's our liability account, right? So we've got equipment going up, equipment increases with the debit, and then we're crediting accounts payable. So that journal entry, debit to equipment, credit to accounts payable. All right. The cost principle. So the cost principle just basically says that when a business buys an asset, the asset should be recorded at actual cost. So when we looked at, for example, that second transaction we purchased, you know, $38,000 worth of equipment. So obviously we're going to put that equipment on our books at $38,000. Or in the previous example, we bought $4,320 worth of equipment. So we would put it on our books at $4,320. And so you know, just to kind of highlight this, it says here, in transaction C, Signal Products had asked $7,500 for the equipment, and Conner's Whitewater Adventures paid $4,320. So again, even if the equipment was worth $7,500, if we paid $4,320, that's what we're recording it for. That is the cost principle, or what is also known as the historical cost concept. Assets have to be recorded at the amount that we paid for them, or the acquisition cost is the little bit more fancy term. All right, here's another example. Conner's Whitewater Adventure paid Signal Products, a creditor, $2,000. So remember, we purchased that equipment from Signal Products, and now we're making a payment to them. So when we purchased the equipment, we debited equipment, credited accounts payable. Now that we're making a payment to them, accounts payable is going down. So we're debiting accounts payable, crediting cash. So this is what that journal entry would look like. Again, we would debit accounts payable, credit cash. So if you think about it, this Signal Products, we owed them $4,320. And now we're to the, we just made this payment. So now we only owe them what? 2,320 type deal, right? All right, so posting to the general ledger. So again, the T account that we've gotten practice with, that's also known as a ledger account. And I put that on the board when we went over this in chapter 2. So the ledger account provides a complete record of the transaction recorded in each account. So, again, these ledger accounts, those are also known as T accounts. That's what we've been getting practice with in chapter 2, right? The collection of all of the T accounts is our general ledger. And then just like we got practice with in chapter 2, posting. So when we say that we're posting something, that means we're transferring a journal entry to the T account. So the process of transferring information from the journal entry, to the T account, to the ledger account. So here's kind of a little illustration or a couple pictures here to illustrate this. So the journal is like the diary of the business. Financial changes are written in chronological or date order, right? So we do our journal entries are all kept track of in that general journal. And then once we do our journal entry, we would want to post it to the T accounts. And so it's kind of showing this analogy here. The T accounts are kind of like separated laundry, right? It says the ledger is like sorted laundry. Grouped information about each account is summarized in one place. So again, we've gotten some practice with the ledger accounts. We did plenty of those together in chapter 2. So now we're focusing on the journal entries here in chapter 3. All right, so here's an example of the general ledger, and this is for cash. So you see the T account, we've got debits. Obviously, debits increase cash. Credits, which are decreases to cash. And so debits minus credits is the ending balance, right? So the balance of an account is always a debit minus a credit. And then the ledger account you'll see here. So we've got the debit column, and we see our debits here. We've got the credit column. We see our credits here. The difference is with this ledger account they're showing us, they're keeping a running total. So the owner invested 90,000 cash, then we had 90,000. We spent 38, then we're down to 52. We spent 2,000, then we're down to 50. We earned 8,000, then we're back up to 58. We spent 1,250, we're down to 56,750, right? So on and so forth. So with the ledger accounts, and especially in accounting software, it's not only keeping track of the debits and the credits, but it's keeping this running balance as well. All right, so then once we post it from the journal to the ledger account, again, in this example, and I know it's got some numbers here and some arrows to help you follow where things go, but if our journal entry was a debit to cash for 90,000 and a credit to owner's capital for 90,000, when we post that, we're going to debit the cash ledger account for 90,000, credit the owner capital ledger account for 90,000, right? And we see it here to capital. So I guess this last slide was showing us when we post it to the cash account. This one's showing us when we post it to the capital account. Again, whatever we did our journal entry for, we're just transferring that information to the T account, AKA ledger account, right? All right, so then preparation of the trial balance. Again, we got some practice with this in chapter 2 together. Once we have all of our T accounts or our ledger accounts updated, we can prepare the trial balance. The trial balance, we've got a column for debits, a column for credits. Any accounts that have a debit balance are going to be listed in the debit column. Any accounts that have a credit balance, those balances would be then listed in the credit column. And the purpose or the goal of the trial balance is to essentially ensure that debits equal credits at the end of that particular step. So after, like, for example, step 3 is posting to the T accounts. So after we've posted all the journal entries to the T accounts, then we, step 4, prepare this trial balance to prove that debits equal credits, right? And we also do the trial balance step 6 of the, so we do the trial balance step 4 of the accounting cycle, step 6 of the accounting cycle, and then step 9 of the accounting cycle are all trial balances, right? And then it's also going to show us some examples as we get toward the end of this PowerPoint on how we can correct some errors. And so, sometimes, depending on what the error is, sometimes we just might have to do like an additional adjusting entry to adjust that account, or we might do a reversing entry to essentially back out the first transaction so that we can record the correct transaction. So there's a couple few different ways that it can be done, and we'll see examples toward the end of this PowerPoint. All right, and here's an example of that trial balance. Again, we got some practice doing a couple of these in chapter 2 together. You guys did this, or were supposed to do this for your homework. And so you'll see those accounts that have a debit balance are listed in the debit column. Accounts that have a credit balance are listed in the credit column. The purpose is to make sure that debits equal credits, right? All right, so steps in the accounting process. So, really they're kind of combining here step 1 and 2. So step 1 and 2, again, step 1, analyze transactions. Step 2, journalize transactions. They have that here. Record the transactions of a business in a journal, right? So that really encompasses step 1 and step 2. Step 1, analyze transactions. Step 2, journalize transactions, right? So those are kind of both encompassed in that record the transactions of a business in a journal, right? Step 3 of the accounting cycle, post entries to the accounts in the ledger, post the transactions to the T accounts. Again, step 4, prepare the trial balance. All right, so source documents, we talked about source documents in chapter 1, chapter 2. Basically, source documents, we use many different source documents to determine what needs to be recorded and how it should be recorded, the amount that it should be recorded for, the date it should be recorded on, all that jazz. And so up to this point, pretty much they've just given us the wording, like, such and such invested, X amount in the business, or, the business bought equipment on credit, or, so they've just given us the wording for each transaction, right? But in reality, a lot of times we have to, we're not just told, this is the transaction. We have to look and we have to gather that information from these source documents. So in this case, this is a source document. It looks like from a vendor or from a supplier that we use, Feynman Company. And it's showing us some things that we bought. So invoice forms, ink cartridges, copy paper, file cabinets. This looks like all office supplies, right? 3 tab folders, electric calculators, black ink pens, mechanical pencils, right? So a lot of office supplies here. So we know that to record this, and we see the amount down here, 675. So we know that when we record this transaction, and it does say terms net 30 days, that means that the entire amount of the invoice is due in 30 days is what that means. And so when we record this transaction, we're looking here, we've got a, bottom line figure or bottom line number here of $675 worth of supplies. So to record this, we would debit supplies, credit accounts payable. And so that's what they're showing us here. Bought supplies on account from Feynman Company. So again, supplies are an asset, supplies increase with the debit. So we're debiting supplies, 675, crediting accounts payable, 675. That accounts payable, that's our liability account, because now we owe that. We have to pay them within 30 days. All right, and then methods for correcting errors. So I mentioned, there's a few different ways that we can do this. The ruling method, which is very rarely used anymore because even small businesses usually have some type of accounting software, whether it's, Intuit QuickBooks or Sage accounting software, another package like that. Even small businesses usually use some type of accounting software. So the ruling method, I would say, is pretty much obsolete at this point, but your book still talks about it, so we'll still touch on it. And then the correcting entry method, which is used more often. So the ruling method, an entry to record payment of $1,500 rent was incorrectly debited to salary expense. So we would go back to that transaction in the general journal and we would mark it out, and then we would write rent expense. And then we'd have to go also to the general ledger, the salary expense account. We'd have to subtract it from the salary expense account. So we would, basically credit the salary expense account, debit the rent expense account, right? The ruling method is basically making manual corrections, right? The correcting entry method, again, depending on what type of error it is, we can either do the correcting entry in one step or two steps. I'll be honest with you guys, whenever I have made errors in the past, I always like to do the two-step method, because as we're going to see with the two-step method, the first step is to do a reversing entry to basically put the accounts back where they were supposed to be. So we do the reversing entry to erase that transaction essentially, or to erase that incorrect journal entry. And then the second step is to do the correct journal entry. And that's kind of what I always like to do, because then it showed it getting backed out basically, and then the correcting entry. But sometimes it makes sense to do the one-step method as well. So we're seeing on this one, it says January 9th, a $620 payment for advertising was incorrectly journalized and posted as a debit to miscellaneous expense and a credit to cash for $620. So it should have went into advertising expense, but it went into miscellaneous expense. So the original entry would have been a debit to miscellaneous expense, a credit to cash, right? That would have been the original entry, but it should have went into advertising expense. So then we're basically going to move it out of miscellaneous into advertising expense. So then we're debiting advertising expense, crediting miscellaneous expense. Expenses increase with the debit. So again, we're moving this 620 out of miscellaneous into advertising expense, right? And then the two-step method. So, again, the original entry would have been a debit to miscellaneous expense, a credit to cash. So then with the two-step method, we're going to do a reverse entry first, and that's what we see here. So we're going to do the reversing entry first. So just the opposite. like I said, the original entry would have been a debit to miscellaneous expense, a credit to cash. So when we do the reversing entry, we're reversing it out, right? We're debiting cash, crediting miscellaneous expense. So we're reversing the incorrect entry. We're backing it out, if you will. And then we're putting it in the correct expense. So debit to advertising expense, credit to cash. I don't know. Honestly, if I had to add them up, I don't know. I think that I've probably only ever done, I don't know, 5 or 6 correcting entries, reversing entries to correct something. And I always preferred the 2-step method because I liked that the first entry reversed it. And so then we were kind of back to even. And then the second entry was the correct entry. It made more sense to me. And I also liked that it showed that we corrected it and did the correct entry, all in one report together. So anyway, all right, that is the end of chapter 3. Let me stop sharing this screen with you. Hi there, everyone. Okay, so I will get this posted into Owlnet, and we will start on chapter 3 next week when we come back after the exam. Let's see, next week is September, the week of September 21st. So I look forward to doing journal entries with you guys. Bye-bye.